Now we come to one of the most important aspects of this reading, which is to understand the LIFO method and how to convert LIFO numbers into FIFO numbers. As I mentioned before, LIFO is permitted under US GAAP and it is not permitted under IFRS. There is a rule called the LIFO conformity rule, which is very important. And this rule says that the same method must be used for tax reporting and financial reporting. In other words, if you are using LIFO for your financial reporting, then that same method is used for tax reporting. This is different from depreciation. With depreciation, you are allowed to use straight line method or whatever method is appropriate for financial reporting, and a different method for tax reporting. Okay, now in this particular case, if a company wants to reduce its taxes, it can use the LIFO method in the United States because that's where it is allowed. LIFO method reduces earnings before tax and then reduces taxes. I mentioned this before also. However, companies which use the LIFO method must also disclose something called the LIFO reserve. LIFO reserve is the difference between inventory reported at FIFO versus inventory if it were reported using the LIFO method. This particular section has two subsections. Section 0.1 will get into the details of LIFO reserve, and then section 2 will deal with LIFO liquidations. Here is the formal definition of the LIFO reserve. It is the difference between the reported LIFO inventory carrying amount and the inventory amount that would have been reported if the FIFO method had been used. US GAAP requires that if you do use LIFO numbers, then in the footnotes you disclose the LIFO reserve so that financial analysts can easily convert from LIFO numbers to FIFO numbers. This LIFO reserve is extremely important in several adjustment related calculations that you will need to make. You look at the balance sheet of a company that is using the LIFO method. The inventory number shown on the balance sheet is the inventory number that is calculated based on LIFO. So how do you convert that into FIFO inventory, or inventory that would have been reported if the company had used FIFO? Just looking at this definition, all you need to do is add the LIFO reserve number. So if the reported number is 150, and in the footnotes you see that the LIFO reserve is 25, then you simply say that the FIFO inventory is 175. Then you go to the income statement and you want to convert the reported COGS number from LIFO to FIFO. If the reported COGS number, let's say, is 100, since the company is using LIFO, the reported number is based on LIFO. How do you convert this to FIFO? What you do is the following. You take the LIFO COGS as your starting point, and then you subtract the change in LIFO reserve. Change in LIFO reserve is the ending LIFO reserve minus the beginning LIFO reserve. If your LIFO reserve at the end of the period is 25 and the LIFO reserve at the beginning of the period is 20, then what is the change in LIFO reserve? That change is 5, and you will have FIFO COGS of 95. So fairly straightforward. Next point. Obviously, you might also want to look at the impact on net income. If you are comparing the net income of two companies, or you are comparing ratios such as net profit margin and so on, where net income is required, then you need to make a net income conversion. FIFO net income is equal to LIFO net income plus the change in LIFO reserve into 1 minus the tax rate. So you need to remember this relationship. And then the FIFO retained earnings is equal to LIFO retained earnings plus LIFO reserve into 1 minus T. There are several relationships here, and I'll suggest a method for remembering all these relationships. This one is easy. Why? Because this is simply the definition. Also note that there are two relationships here which are balance sheet based, and there are two relationships which are income statement based. The top one is a balance sheet relationship, and the bottom one is a balance sheet relationship. The balance sheet reports cumulative numbers in the sense that you are looking at your total inventory at a given point in time, or your total accumulated retained earnings. With balance sheet related calculations, we use the ending value of the LIFO reserve. And then obviously with retained earnings, there's going to be a tax impact, so you do 1 minus T. The middle two expressions here are related to the income statement. Whenever you are dealing with the income statement, there you consider the change in LIFO reserve. So notice that there is a change in LIFO reserve. So this will help you remember where to use the LIFO reserve versus where to use the change. That's point number one. Point number two is where do you plus and where do you minus? Because it is easy to imagine questions which are testing you as to whether you know whether to plus or minus. Okay. Hopefully you recognize the fact that in an environment of rising prices, which is the typical environment, FIFO inventory is going to be more than LIFO inventory. So that's why you have a plus sign. You also recognize that in the typical environment where prices are rising, FIFO COGS will be lower than LIFO COGS. So that explains the minus sign. FIFO net income is going to be higher. So that explains the plus. If net income is higher, then retained earnings will also be higher. So that explains the plus. And then the third point, how do you remember this 1 minus T? Obviously, if your income is going to be higher, there is also going to be a higher tax. So the impact of tax needs to be taken out. And that's where the 1 minus T comes into play. Before I come to the definition of LIFO liquidations, I'll just give you some high-level points. In periods of rising inventory, the carrying amount of inventory under FIFO will exceed the carrying amount of inventory under LIFO. I'll give you a very straightforward example to illustrate this point. Let's say that you are buying inventory and you first buy at $1 a piece, then you're buying at $2 a piece, then you are buying at $3 a piece. So this is time. In periods of rising inventory, which means that your inventory balances are increasing, and let's say that you are using the FIFO method. If you are using the FIFO method, then you are selling the low cost inventory. Your inventory balances are rising, which means that inventories that are valued higher, those balances are rising. So the difference between FIFO and LIFO keeps increasing. And the difference between FIFO and LIFO is the LIFO reserve. So that is the straightforward point being made over here. So these are two sub-points that you need to remember. The LIFO reserve may increase for two reasons: increasing difference between older costs used to value inventory under LIFO and more recent costs used to value inventory under FIFO. So that's illustrated by this simple example. Also, the number of units manufactured or purchased exceeds the number of units sold. So if these two things are happening, then you have an increase in LIFO reserve. LIFO liquidation refers to the opposite scenario. If you have a situation where the number of units sold exceeds units purchased or manufactured, then you have LIFO liquidation. Now coming back to this scenario, a company is using LIFO and the units being sold exceeds the units being purchased or manufactured. That means that a company then is dipping into these older layers, and a company might be selling over here, but now the COGS is indicating that you are selling inventory that is only worth $1. So this is called LIFO liquidation, where you are dipping into old cost or low cost inventory. What will that do to your COGS? It will make the COGS appear low relative to current prices. And what will that do to gross profit? It will make the gross profit look high. But will this high gross profit be a good indication of what you can expect in the future? No, because in the future, obviously, you'll be buying at current prices. So as an analyst, if you observe a decrease in the LIFO reserve, then that is a warning sign that the current profits are higher than what you can expect in the future. This can also be used by management to manipulate earnings. If management wants to show higher earnings, then potentially they can do things that allow them to dip into old inventory. So you as an analyst need to be careful whenever you see LIFO reserves decreasing. All right, now here is a quick check of whether you are understanding what's going on. I want you to think about this, come up with an answer before I give you the answer. The correct answer is company A. And how do we know this? First of all, when you have LIFO versus FIFO and you are talking about an income statement item, immediately you know that it's going to be LIFO and not FIFO. Then you also need to consider what's happening to the LIFO reserve. A decrease in LIFO reserve means that there is LIFO liquidation taking place and COGS is reflecting old prices because we are dipping into older layers. So that would mean that between A and C, company A is the better answer. So fairly important. You might see questions like this at the end of this reading.